Hello traders, in this video we are going to take a look at a very simple concept, the subtle difference between inside bar and the Japanese pattern, the bullish and the bearish Harami pattern. I will be using the trading view platform to explain the difference and show the ways in which you can easily pinpoint them and place an order that is trade based on the pattern. But before we go there, how to trade it, it's very important for us to understand what is the basic difference between the inside bar and the bullish bearish Harami pattern. So let's come here and let's understand the basic subtle differences. First and foremost, the inside bar and the bullish bearish Harami pattern has got to do with the range and the body. So for example, for the inside bar, the range is considered, but when it comes to the bullish bearish Harami pattern, it is the body of the candlestick which is more important. Let me draw and explain this difference to you. When it comes to inside bar, what we are looking for is one particular candlestick which is completely inside the body of the previous day. So we are considered, or we will be looking into, what is the range of, let's say, day 2, and that range of day 2 should completely be inside the range of day 1. No part of day 2 can go outside the range of day 1. It can be a green candlestick followed by a red, green, positive, whatever it is, that doesn't matter. The only thing that matters over here, as you can clearly see, is contraction. It does not look into the underlying trend of the market. It does not have any specifications that the previous day has to be negative, today has to be positive, and all that stuff. The only thing is range contraction, means the entire range, and when we say range, I mean high minus low difference of day 2, the second bar, has to be completely inside the range of day 1, that is the previous day. That's inside bar. But when you come to the bullish bearish Harami pattern, first of all, the body is important. Second of all, the coloring of the candlesticks is also important. Let's first talk about the bullish Harami pattern. For the bullish Harami pattern, the first candlestick has to be negative. Now this is where specifications come into play. The second bar has to be positive, like this. For the bearish Harami pattern, the first bar has to be bullish and the second bar has to be bearish. So first and foremost, the color is important. The body is important, that is the entire body of day 2, that is the small green candlestick. I am talking about only the body, nothing to do with the shadows. Has to be completely inside the body of day 1. The shadows can shoot out like this, it can go outside the range of the previous day, does not matter. The only thing that matters over here is this particular small body has to be completely inside the previous body. This is what matters, that is in terms of the body. And then in the bullish and the bearish Harami pattern, the positioning is also critical. When I talk about the positioning, the bullish Harami has to always come after a short-term downtrend. That is, the market has to go through a short-term correction. And when you talk about the bearish Harami pattern, the stock has to go through a short-term uptrend. So not only the body is important, The positioning is also very important, and the color of the candle, let's say I use the word color, also very important. So as you can see, when you look at the basic nature of a inside bar and the Harami pattern, the Harami pattern seems to have far more specifications, criteria, requirements. The previous trend is important, that is the positioning. The colors is very important of the day 1 and the day 2, and the specification about the body. But when you look at that aspect for the inside bar, it's just looking at range contraction. It's not required for the positioning or any such color of the bars. Nevertheless, most of the time what we find or what we are interested in, those who trade the inside bar or the bullish bearish Harami pattern, the key aspect of this is this contraction. This range is contracting, or the body is smaller, which essentially means that the market has slowed down and the market is likely to give a move. Now it's our ability, our analysis, which way is the move going to come? Is it going to give a breakout on the upside or the downside? So let's talk about how we can figure out which way the directional breakout may come. Now, does volume play a role? I'm not a big fan of using volume in the trading strategies and setups which I personally trade and share, but yes, to some extent we can look at it. So let's go to the chart straight away. Now that we've understood the concept, let's come straight away to the charts. I have the chart of Maruti Suzuki first month futures daily chart using the trading view platform here. These are the hollow candles, and down there I have the volumes with the 5-day average volumes. Okay, so if you look at this particular behavior, this is a bearish Harami pattern, clean bearish Harami pattern where we have a short-term uptrend and small red body inside the body of the green. The shadows have gone up, doesn't matter, but this is a bearish Harami pattern. The way to trade the bearish Harami pattern, the good thing about the bearish and the bullish Harami pattern is they give us a sense of the direction that we can expect. So when it's a bearish Harami pattern, we will be placing orders below the low and placing a stop loss above the recent high between the 2 days, whichever is the recent high. So we clearly can place an order on the downside. We are expecting a fall, which is a good thing about the Harami pattern, which is not there when it comes to inside bar. We'll talk about that. Now when you look at this fall, it's a sharp fall, and then we got one positive candle inside the body of a long red candle. This is also a bullish Harami pattern. We can place an order to buy above this high, and for that we should use the recent low, whichever that is the longer candle or the shorter candle, as a stop loss. Few things. The size of the previous trend is very important. We should have some movement. I would say at least 3 to 5 days of movement. Just by looking at it, it should give you a sense that yes, there has been a trend which needs a short-term consolidation or reversal, right? Do not just blindly go for example, I think it is there. Is it? Let's look at these. They don't look like an exact Harami pattern to me, but then if you look at this green small body inside the red, or this one inside, they are not bullish Harami pattern. Yes, a green body, a smaller green body might be inside a longer red body, but that does not qualify this to be a bullish Harami pattern, because it needs to come after a downtrend. Please note this. This is very, very important. So trading a bullish or a bearish Harami pattern is not very difficult. It's just you have to find the pattern. Number one, you have to figure out the positioning of it. And also I would suggest that always trade those patterns where the range has contracted. For example, this one, the second example on the chart of Maruti is something that I wouldn't trade. This is still doable. I personally wouldn't like to, because the range is really, really wide. My entry and stop loss differences is pretty high. You can check one of my videos wherein I speak about the ATR and the Bollinger Band, how both the volatility indicators are combined to find out a good point of entry as well as a good point of exit also to book partial or full profits. The link of this video I'll give down below in the description box. You can definitely take a look at it. So that's the bullish and the bearish Harami pattern, and I was talking about, does volume play a role or not, right? If you look at the volumes, I would suggest this, that the day you get the pattern, look for volumes to be as low as possible. I always prefer that volume should be that is below the 5-day average mark. See, what happens is the big moves come with very high volumes. Most of the time you will find high volume, high ranged price movements. We don't want to enter a stock or a trade after it has already given a high volume, high ranged movement. We want to enter the stock before that movement. We want to make use of that movement. And so we would like to get into a stock where the volumes are sub-average. Now this is relative in nature. What are the absolute volumes in Maruti can be very, very different from what are the absolute volumes in State Bank of India. And so a good way to do this is use a 5-day average. And look for instances where volumes have dropped down. Lower the volumes, the better it is, honestly. Okay. What can we do in this kind of a situation? As I'm looking at the chart of State Bank of India, it was a 1-2 slipping from the high. It was a 2-day correction, creates a bullish Harami pattern, sub-average volumes, moves above the high, gives a nice 2-day move. Comes down for 1 day, then creates another bullish Harami pattern. Now, I wouldn't call this a bullish Harami pattern. I'll call this an inside bar because not enough downtrend. Similarly, over here, we've got a 2-day movement. I'll rather call it an inside bar than a bullish Harami pattern. I think we can call this because this is one pretty long red candle. This is a little subjective in nature. We can put a rule to this, let's say a 3% fall or a 5% fall. But then a few things in technical analysis should be subjective. That's the art of the subject. So I think the concept of volume should be clear. You should be looking for as low volumes as possible. On the day, on the bar, you're getting the pattern. Okay. Before I move on, I'll take this example just to elaborate my point further. You look at this bullish engulfing. This is a Japanese candlestick pattern which suggests a reversal. You see that when the pattern is shaping up, the volumes are pretty low. When the pattern is a success and the stock starts to break out and rally, huge volumes. I don't want you to participate here. Would like you to participate down here so that you make use of this move and not get attracted by this move. Okay, let's keep this in mind. So volume should be as low, as sub-average as possible. So trading the Harami pattern should not be a problem. Now the point is, how can we find out in a list of 200 or 500 stocks which are the stocks which have satisfied the condition of a bullish Harami or the bearish Harami? Now before I go to the inside bar, I would suggest that there is something called the Mentorship Insta View report. It's a newsletter which I email to everyone free, wherein I share my view on the markets, a small write-up on the Nifty, and then scanning the cash stocks within the Nifty 200 universe for some conditions, out of which there is a bullish and the bearish Harami pattern. I email this every trading day on the evening around 8 to 9 p.m. and I use the Iris Plus software to scan this, and then I visually check. It's not that whatever comes I put it on the report and send it out. So I personally scan it out to figure out which are the bullish bearish Harami pattern which should qualify. That is, I look into the underlying trend very closely, I look into the range very closely, and then I share a truncated list. Okay. Right on top of this, you will find that I also share a list of inside bar plus low volumes. I just spoke about what is the importance of low volumes. We have spoken about what is inside bar. And so I scan for those stocks which have created an inside bar with low volumes, and I share the list. So all that you have to do is focus on these stocks for the next day. For example, in this list, let's say Torrent Pharma. Okay, let's come here and try and open Torrent Pharma. So you can see here Torrent Pharma has created an inside bar. This bar is completely within the range of the previous day. Both of them are red, and the volumes have been very low. So this is an inside bar with low volumes. Now a big question mark is, see, whether to put a buy order or a sell order after the bullish Harami is clear, but what order should we place here? Before I tell you few filters that we can use, one very simple rudimentary age-old system is put a order to buy above this and a stop loss below this. Also put a order to sell below this and a stop loss order to buy above this. So whichever comes first, you go with the flow, which means that you're completely unbiased. You do not want to create any directional bias. If the price goes above the high, you will buy, low as a stop loss. On the other hand, if the price falls below the low first, you will short with high as a stop loss and stop and reverse. That is, if you bought and it came down, your stop loss is hit, not only will you exit, but you will go double short again. This is a very simple, rudimentary, not to use your intelligence too much, not to judge the market or have any bias kind of an approach. Of course, it works at times, but I personally do not favor this. I personally do not favor this because then what is the point of spending 17, 18, 20 years in the market? And then if I say that I cannot create a bias, then what's the point of specializing or being a domain expert? If after spending so many years you say that I cannot create any bias, I cannot analyze which way it will go, then it is as good as not even spending those 20 years, right? I could have spent those years doing something else and done this kind of trades. They work. It's not that they do not work. It's just that it doesn't sound very intelligent. Now, you want to sound intelligent or have some kind of a bias? How can we do this? The two ways in which we can do this is momentum and counter momentum. Momentum. Let's plot a simple 5-day moving average, exponential 5-day moving average like this, and for which I'm using at least a 3-bar reversal. So for example, if the slope of the moving average is down, the slope, once it starts to go up, will only move up on the 3rd day. You see this is red. The moving average slope is going up, but it's still red. So I'm giving it some space, some room. So one way to do this is place the order based on the underlying momentum of the stock. So in this case, I think the momentum has, unless I hide it, it's very difficult. It's still positive. See, it's blue. It's still positive. So for this, based on the momentum, I would rather place it on the long side with the low as a stop loss. This kind of a momentum play with the inside bar works very well when the stock is rising, the stock is on the up move, or the short side is when the stock is on the down move. Let me see if I can spot any such for you. Let's say this one. See, this is an inside bar. Right after this bearish engulfing, it created an inside bar. The slope of the moving average is positive, that is rising. Place above this, low as a stop loss. You got this intraday move. Oh, by the way, I use the word intraday. Both these trades, prospective trades from inside bar and Harami pattern, try and do them as short term as possible. Intraday would be best, max to max 1 to 2 days. For inside bar, I would strongly suggest intraday only. For the bullish bearish Harami pattern, it has got some more meat to it, so it can be a 1 to 2 day trade. But for the inside bar that I'm showing you right now, please stick to intraday only. So this is a high momentum inside bar right here. It's a very high momentum inside bar. Above the high, low as the stop loss. So you're chasing momentum on the upside. Of course, at times it works really well. For example, this is a high momentum inside bar. This is also a bearish Harami pattern, only below the low. It never came. Went above the high, gave you some small move, but the big move came the next day. Part and parcel of the game. So momentum filtration can be done in various ways. For example, let's come to the list. This is the list for today. This I have sent out last evening, which is the 8th of March. Today I'm making this video on the 9th of March. And so let's say we look at something like a Hiro Motoko. So Hiro Motoko over here, let's come to the last candle. So it's made a high momentum inside bar. The momentum has shift up 1, 2, 3. It's created an inside bar. So I will create a bias if I have to trade my inside bar based on this moving average. Then I'll be placing an order on the long side with low as a stop loss. That's number one. The number two approach to trade the inside bar is counter momentum or pullback. I prefer this one far more than going with the momentum. Both has its own pros and cons. I'm not saying this is good, this is bad. It's just that it suits me. So I will be trading the counter momentum or the pullback more. So I'll be looking to buy on a dip and sell on a rise. And for this, I have a filter which I call the Oracle. And again, don't worry, I scan this every day and I share the list freely to everyone who is subscribed to the newsletter, registered for the newsletter. So bullish Oracle and bearish Oracle. Say for example, in bullish Oracle, we've got quite a bit of stocks today. What do we have? We have, let's take a look at Indus Tower. So when we look at an Indus Tower, okay, by just the look of it, you can clearly see that the underlying trend is, the drift is on the upside. Yes, we can use moving averages like a 34 period or 50 period, whatever. It looks like an uptrend. And then it has gone through a short-term correction. And now it has created a bullish Harami pattern. It has also created an inside bar. Volumes are pretty sub-average. So I am going to place an order above the high. This way, if I trade an inside bar, I'm more keen to trade it based on the underlying trend and the short-term correction. In an uptrend, I would like to wait for a price drop and expect it to continue on the upside. Similarly, in a downtrend, I would wait for a bounce back. Let's say if I can see such an example here on Indus Tower. So in a downtrend, I would wait for a bounce back and then get overbought. That is, there are certain rules of the Oracle system here, and then look to trade intraday on the downside. I'm not going to go into details about the Oracle because it might be a little more complex. It will require specific softwares and indicators of indicators and scanners. That's why I'm not going to explain this in this video. You can take a look at the system. I took a webinar recently. The link of the webinar is down there. Those who are interested can take a look. And those who are not, you can subscribe to this newsletter. Very simple. You can come to the website mentorshiptraders.com. Just scroll down a little bit. Subscribe to newsletter. Just put in your name and email address and you're good to go. Your inbox will get this emailer Monday to Friday in the evening. A write-up on the Nifty and some scans. Some inside bars with low volumes, some bullish bearish Harami pattern, few stocks which have come on the scanner for high delivery percentage, few stocks which I feel is likely to give a breakout anytime soon, and then the inside bars filtered out with the bullish and the bearish Oracle. Once you get this list, you can keep a bullish approach. Take a look at the market opening. If the price opens away from the high or the low, do not trade them. Please remember this. If you have a trade, let's say on a particular stock, wherein you feel that this is the last day's candlestick and tomorrow morning I'm going to place an order above this high, and these are all intraday trades, and if the market opens slightly higher because of some gap up, do not let it go. Do not place the order. The best case scenarios, the most profitable scenarios which I have figured out is if I've spotted a trade which I'm going to go long at a certain price and it opens within the body and now it gets traded and then moves. These kind of moves I feel creates much better profits rather than chasing those stocks which have had an emotional opening, strong on the upside or weak on the downside. I'm sorry this video turned out to be a little longer than I anticipated, but I hope that you found it useful. Do share your suggestions and your feedback, and I can extend this further and discuss more and add value to this concept. Thank you. Thanks a lot. Trade well and take care of yourself.